Imagine an empire of wealth built over years, turning to dust in the time it takes to grab a coffee. On June 25th, $1 trillion of digital capital simply evaporated, leaving the global financial system in shock. The casualties were concrete. $1 trillion wiped from the S&P 500, while the Nasdaq plummeted 1,000 points. The market opened in the green, but from that peak to the bottom, the clock moved forward only 27 minutes. Panic took over trading floors and retail apps alike. Investors watched their portfolios bleed out in real time, searching for a news headline or a global catastrophe that could explain why the floor had suddenly disappeared. How does 83 lakh crore rupees, a full $1 trillion, vanish during a seemingly normal trading day? The sheer speed of the collapse suggests that the 27-minute window wasn't driven by human news or rational events, but by a sudden break in the market's internal mechanics. Data, their primary tool for tracking how fast prices are rising across the economy. The data showed a significant spike. Inflation had climbed to 4.1%, more than double the Federal Reserve's long-term safety target of 2%. It's the realization that the astronomical cost of building and running AI technology is no longer being paid by venture capitalists, but is now being passed directly to the consumer. The markets reacted with a 6% drop in Apple stock, instantly removing $220 billion from its total valuation. When the richest tech giant on the planet signals that AI costs are hurting its margins, it calls into question the future profitability of the entire technology sector. Apple's valuation drop applied heavy downward pressure on an index already saturated with high-risk positions. To understand why the fall was so violent, we have to look at leverage, the practice of trading the markets using massive amounts of borrowed capital. Assets in 3x leveraged ETFs focused on the Nasdaq have grown by 300% since April, reaching $40 billion. They triple gains on the way up, but when the market dips, leverage accelerates losses at 3 times the speed. As prices began to fall, automated trading algorithms triggered margin calls. These systems are programmed to automatically sell off assets to cover borrowed money, creating a self-reinforcing downward spiral. This chain reaction of forced selling quickly moved beyond stocks and into the highly leveraged cryptocurrency markets. In just 60 minutes, $500 million in leveraged long positions were liquidated, forcing Bitcoin down to a 21-month low of $58,000. The 27-minute window reveals a market where human decision-making was replaced by a rapid-fire sequence of automated liquidations, each one triggering the next. This pattern of extreme borrowing isn't confined to New York. It has become a global phenomenon affecting major tech-driven economies. The tech hubs of South Korea, which provide the physical components for the AI industry, have seen a massive influx of retail investors using borrowed money to chase the same trends. We are seeing the same buildup of high-risk, leveraged capital across the stock market in Taiwan. In these two countries, the amount of money in leveraged ETFs has skyrocketed 490% since January, now sitting at a record $65 billion. We are living through a period of historic technological advancement with AI, but that growth is currently being financed by record levels of debt, while inflation remains stubbornly high. When a market is built on this much borrowed money, it becomes a glass house, beautiful and impressive, until a single crack in the foundation is enough to shatter the entire structure. Chasing triple-digit returns using leverage in a market this sensitive to price spikes and algorithm liquidations is a path towards significant financial risk. True wealth in an era of AI-flation isn't built through high-speed speculation, but through the discipline of long-term planning and a refusal to participate in the dangerous